Hello guys, Tina here. In this video, I want us to talk extensively about liquidity. Liquidity is such an important aspect of trading as much as market structure, the market structure that we all know about. Okay, I remember in the last video for either break of structures or market structure rather, they are all structures. I mentioned something like if you have an understanding of market structure, then 50% of your problem in the market is solved. Okay, and that is also the same for liquidity. I think another part of the percentage is liquidity. If we have 50% for structure, maybe 10% or 20% rather should be for liquidity. Okay, because there's a saying that if you cannot spot liquidity in the market, then you are the liquidity or you will be used as liquidity. Okay, so that is why it is very important for you to understand the whole concept of liquidity extensively. Okay, because it's actually a broad topic and it needs to be understood. If you understand it from every angle of comprehension, then you will likely never be caught unawares in the market. So today we are going to be covering what liquidity means by itself, the major types of liquidity, other types of liquidity, and then of course finally the importance of liquidity. And I will also try to give a few examples if time allows us. But this is me trying to explain everything that has to do with liquidity. And in several videos I'm going to also be talking about liquidity as different topics, okay, other types of liquidities as a full topic. All right, just to enhance more understanding on what liquidity is all about, and also to show you that it is quite a broad topic and each and every one of them is very important for you to understand because they have their role to help in helping your understanding of the market. Okay, so what is liquidity? Liquidity refers to areas in the market where a large number of buy orders or sell orders are waiting to be executed. These areas attract institutional traders because they need large amounts of orders to enter or exit the market efficiently. Okay, simply put, liquidity is where money is or where order is waiting in the market, where money or orders is waiting in the market. Okay, so it's just as simple as that. Liquidity is simply money, and money is what moves the market. Now we have major types of liquidity. We have like three major types of liquidity. Okay, while there are several types of liquidities, we have three major types. And the first major type is inducement liquidity. This is a very important type of liquidity that if you don't understand it, you are finished already, honestly, because you will likely never know where to place your trade or how to even place your trade. Okay, the second type of liquidity is what? Transactional liquidity. And the last type of major liquidity is structural liquidity. And I'm going to explain it in the best way possible, and then we talk about the other types of liquidity. Okay, for inducement liquidity, inducement itself is a trap for early traders. That's why I said that if you don't understand inducement liquidity, then best believe that you will likely always be caught in the market. You'll always likely be used first of all as that liquidity, that inducement itself. You'll be used as that liquidity, or you will likely not know how to place your entries in the market. Okay, so inducement liquidity is a trap for early traders, usually formed in the lower time frame. It is the most recent break of structure internally. Okay, that is for internal structures. Okay, and if it is something like on the higher time frame, you will still see an inducement, but it's just that you might not be able to identify it very well. Of course, I'm going to also try my best to show you how to actually spot that liquidity if you're a higher time frame trader like myself. Okay, for lower time frame traders, they see the most recent break of structure as what? As liquidity. So this is example. So let's assume that we are actually in an uptrend. There's something that looks like this. Okay, when we have something like this, Now, the recent break of structure, the most recent break, that is the second one I just drew, is actually seen as the inducement in the lower time frame. Okay, in the lower time frame, remember that the lower time frame moved into it. I've already talked about everything that has to do with break of structure, change of character, so we are not going back to any of that. So what you can see here is what an inducement. Okay, and whenever there is something like this, you're going to make sure that your order is not going to come somewhere around here. If you're going to place your order in the market, then you're going to make use of what? You're going to make use of this second level. You're going to find the valid order block in this second demand level to place your what? To place your order, while this one here serves what? As an inducement. I don't know if that was clear. Okay, so it's usually the last low that is what? That is created. That is for an uptrend, and then the last high to be created if it's for what? A downtrend. Okay, might not be so understandable now, but of course I'm going to still explain further. Now what I'm showing you is just a figure. I'm just showing you a figure for a lower time frame inducement. So just notice that the most recent break of structure is what? The inducement for what? For the lower time frame. Very simple, very comprehensive. Okay, so when you want to place your order in the market, when we have something like this, where your order should come should be what? Somewhere around here, because the moment price comes, price taps into the order block here. It taps right into this order block, and the next thing is what? It's quite high. Okay, this is for what? For an uptrend in the lower time frame. I don't know if that was understood. And this is a particular pattern that a lot of traders follow. If you're an SMC trader, I'm sure you are already conversant with this particular pattern forming on the chart, right? So that is it for inducement liquidity. There are other ways to spot inducements, but of course we're going to stop it at this one. I would have shown you like several other figures that shows how inducement happens, but I'll just make use of this one because of time. And then we have the transactional liquidity. The transactional liquidity is simply the liquidity that is in charge of clearing previous strong points. Okay, previous strong points. It is in charge of creating reversals for continuation. It is in charge of creating flip zones. Okay, it has to do with both lower and higher time frame. So I know I have explained this thing somewhere in our previous video. Somewhere in our previous video on break of structures, I actually had a way of explaining transactional liquidity. Now let's take for instance that the market is in an uptrend. This is what a transactional liquidity looks like. Let's take for instance that we are in an uptrend. We are currently in an uptrend. Price moving progressively. Price moving progressively in an uptrend, and then suddenly there was what? A change of character. Okay, if this is an external, we are let's assume that this is on a higher time frame or on a 4-hour time frame. We are going to see this as a complete change of character. If it's on the lower time frame, then we need a change of character and an extra break of structure to confirm it. Okay, but in this case, let's use the external to make the illustration. All right, so there was a change of character, that is price taking out this particular swing low that it was not supposed to take out in the first place, if at all the uptrend was supposed to be progressing. Okay, if price takes it out, there's already what? Change of character. And the moment there is a change of character, what happens next? Price will begin to what? Price will begin to cancel out. Now it has cancelled out this one. It's about to cancel out this particular low. Price will continue to create more structures that what? Oh, my space has finished. Price will continue to create more structures. I want to believe you understand what I'm trying to do. Price will continue to create more break of structures that will take out this particular one here, and progressively until it takes out every structure that was created when price was moving in an uptrend. Okay, that is exactly what transactional liquidity is all about. The rule of transactional liquidity states that once there is a valid change of character, as you can see here, on a particular trend, price tends to use previous externals as transactional what? Liquidity. That's exactly what I'm trying to explain here. Provided price is moving on a trend, whether it is uptrend or a downtrend, and then there is a sudden change of character, price tends to use the externals or the structures that were created during that trend. Price cancels them out as what? Transactional liquidity. I know you understand what transaction means. Take it in the sense of sales and marketing, where you give money, where somebody gives you money and buys your goods and all of that. That's a transaction. So that's the same thing that is happening here. In mathematics, we have times in divisions, in division, a particular number cancels the other, and that's exactly what's also happening here. You see, price, the moment there was a change of character, price cancels out this level, cancels out this level, and that's transactional liquidity, also known as what? Trend line liquidity. Some people understand it as trend line liquidity, and trend line liquidity is like another type of liquidity that people also know. So you have to be conversant, like I said, with all the types of liquidity, because they all have their roles in helping you your versatility in the market. All right. So that's for transactional liquidity. I want to believe that it was also very clear. Then the last type of liquidity is what? The structural liquidity. This is simply a minor break of structure found inside the internal liquidity or break of structure. I mentioned it in the break of structure class that when you come to the internals, one of the rules for a valid internal is that there is supposed to be a structural liquidity inside of that break of structure for the internals. Okay, there has to be some sort of what? Structural liquidity. The qualification for a valid internal is that it has to sweep structural liquidity. Okay, this one is not compulsory, but in terms of creating structural liquidity, it is very compulsory for an internal break of structure to create structural liquidity. If a break of structure on the lower time frame does not have structural liquidity, that means that particular break of structure that you can see is a structural liquidity on its own. If you cannot find several structural liquidities, several minor break of structures inside an internal break of structure, then that particular break of structure is what? It's not valid, and therefore you don't have any reason to even place your trade. You don't have, because that one will be used as liquidity itself, which is what? Structural liquidity. And also, if an inducement does not have what? Structural liquidity, then it is a structural liquidity itself. Take for instance, we have this break of structure. I said that the most recent break of structure, which is this one, is what? Is the inducement. If this particular break of structure does not have any structural liquidity inside of it, then it on its own, it is what? A structural liquidity. So you cannot call it an inducement. You cannot call it a valid break of structure. So for you to know a valid break of structure or a valid internal break of structure, there has to be what? Structural liquidity inside of it. Okay. So I've been able to run through the three types of what. Okay. I also explained how to spot your structural liquidity. Structural liquidity is like the minor breaks, because inside every break of structure there are minor breaks inside of it, and those minor breaks you can see are what? They are what? The structural liquidity. And for the external, for you to know a valid external, like I said in the previous class, there has to be what? 2 or 3 internal break of structures inside that particular external break of structure. If you don't understand this, please go back to the previous class on break of structures, and then you will understand it. Because everything I'm talking about is in hierarchy, because I know that if you don't understand this particular one, you might not be able to understand the next one I'll talk about. So that's why it's very important that I follow it, chronologically, and in the order of what? Importance, in sequence. All right. So the other types of liquidities that the next topic is other types of liquidity. Of course, there are other types of what? Liquidity. We have the buy side liquidity. Okay, we have the sell side liquidity. We have the external liquidity. We have the internal liquidity. We have liquidity grab, and we have liquidity sweep. And let's take a break from here, and I'll come back and explain, these other types of liquidity in details. Hello guys, welcome back. So we stopped at the other types of liquidity, of which I already mentioned: the buy side liquidity, the sell side liquidity, the internal, external liquidity. We also have the liquidity sweep and liquidity grab, and I'm going to use this particular structure here to explain all of them, or most of them rather, to show you that all of these liquidity concepts, they are all related to each other. Just like you saw me relate this transactional liquidity to the trend line liquidity that we all know about. Okay, but like I said, it's very important for you to understand each of these liquidity concepts, within their own uniqueness. Just understand them. That way, it helps you to correlate and, improve or enhance your understanding of the market and then your understanding of the topic liquidity as a whole. All right, so let's get right into it. The first other type of liquidity we have here is the buy side liquidity. The buy side liquidity is a liquidity that is found above previous highs. Okay, it consists of buy stop orders and stop losses of traders who are selling. Okay, so for instance, what that implies is that it consists of buy stop orders. What is a buy stop order? A buy stop order is order placed by sellers to, at a region where they expect price to stop buying and now continue selling. For instance, price was buying and got to this level. A seller might place a buy stop order here, telling the broker or the executor that I want, when price gets to this level, let price stop, I'm expecting that price should stop buying from this level. So I'm placing my sell order here with hope that price will start selling the moment it gets here. So you see that seller will place their order somewhere around this supply zone and then put their stop loss above this level. Okay, and with that hope that, of course, but because this place is a buy side liquidity, that is, if that seller is on the wrong side of the market, okay, you will see that price will come and sweep above this high because there's liquidity resting here. Okay, in fact, whether the seller is on the wrong side or on the right side, there's always liquidity resting here. The only difference is that if that person is on the right side, price would respect that particular order that the seller has placed. Okay, so price will sweep above that buy stop order and then sweep above the stop loss, and in some cases will not begin to sell down, or in some cases continue buying strongly. All right, so that's like what a buy side liquidity implies. Institutions may push price above these highs to trigger those orders before reversing or continuing. Okay, liquidity above highs. So every high you see in the market, there is a liquidity resting on that particular high. All right, and these are regions that help you to know where to, place your targets. If you're on a buy trade, just like this particular buy setup here, you already know that, the chances of price sweeping above this high because of this liquidity is very high. So you're going to place your take profit around that region. All right. So we have the sell side liquidity. The sell side liquidity is now found below previous lows. Okay. It consists of sell stop orders and stop losses of traders who are buying. So let's assume that this is a particular low, and a buyer will not place their order around here, maybe a sell stop order around here, telling the market that, okay, expecting that if the market should sell to this point, then it should bounce from this level, a demand zone or a support zone, you understand, to start buying. Okay, so a buyer will likely place their sell stop order around here, but because there's liquidity resting here, okay, liquidity resting above this particular low, price will likely come, sweep at that particular order. The person will place their order around here and possibly a stop loss around here. Price will take it out and even take out the stop loss order, and if it takes it out, it can now decide to start buying, or it will continue to also start selling. All right, so that's what we call, if price takes it out only to still go to the direction that the buyer expected. That's where you hear things like failed order blocks, all right, in SMC, because price has failed it. And then you also hear concepts like reclaimed block. When price fails a particular order block and then goes back in the same direction, that's what reclaimed block, that's reclamation. Okay, price decided to reclaim that previous trend, okay, that it was initially going. So like I said, in some cases price will continue selling, in some cases it will take the buyer out and continue buying in that same direction that the buyer expected. So institutions may drive price below these lows to collect liquidity before moving higher or continuing lower. Okay, so if you're actually a trader, these are things you need to pay attention to. You need to know that in these highs and lows, there are liquidity, I'm sorry, the liquidity resting around them. So we have an external liquidity. Even within this range, you're still going to find your internal and what external liquidity. And external liquidity is found at major swing highs and major swing lows. All right. Let's use this particular structure because this is an uptrend. So let's just use it. Whatever it is I say here, you can apply it the other way around, okay, for the sell side. But because this is a buy figure, I'm going to use it to explain the external range liquidity. Now, for this external, this is a major swing here, okay? It's also the same as, the buy side liquidity, but this is another name for it now, external liquidity. There's liquidity resting above this level, and if it is on a downtrend, there's a liquidity resting around this low, okay? So these are obvious levels that many traders can see because many stop losses and pending orders accumulate there. Institutions often target what? These levels, okay? Now, internal liquidity are the ones that you find within the current price range. The next topic we're going to be talking about is range, because range is another thing that you need to understand as a trader. Okay, once you have your understanding about range, it helps you to actually know where the market is headed next. Okay, I'm going to take my time to also explain that in a different video, and that's going to be our next topic by the grace of God when we are done with everything that has to do with liquidity. Okay, so let me explain. Like we said, internal liquidity is the one that is within the current price range. It is formed by smaller highs and lows inside the broader market structure. These levels are often targeted before price reaches the external liquidity. It's just as simple as that. Now, what I'm trying to say is that when price created this structure, it has created a range. From here, from this particular low to this first high here is a range. Now, in most cases, when price creates a range like this, for it to give a new break of structure, it comes into at least 50% of this very range and then creates a new range. And that new range is usually known as external range liquidity. Whereas the low that created that external is called the internal range liquidity. I hope that was clear. So when we talk about internal liquidity, this is the liquidity that price always takes out first before it goes for the external range liquidity. What does that tell you? That is still an inducement liquidity. Because when we explained inducements in the first part of this video, when we explained inducement as this most recent break of structure, and so price needs to take it out to tap into the main POI, okay? And now we are still explaining that inducement liquidity. We are still explaining it as internal range liquidity. So now different traders can see it differently, but like I said, you will be on a greater advantage to understand them uniquely for what they are and then correlate them and know that they are all saying the same thing. And at the same time, you don't need to know all of them too, because they are all still saying the same thing. All right. So this low here is known as the internal range liquidity. So price goes from internal range liquidity, from taking out internal range liquidity to taking out the external range liquidity, which is around this level. I hope that was quite understood. Okay. So we have the next one, liquidity grab. Liquidity grab occurs when price briefly moves above a high or below a low to trigger stop losses and pending orders before reversing. This is also what we call a liquidity grab. When price goes for the external range liquidity, or goes for a buy side liquidity, or go for a high or low, those and trigger, of course, when it does that, there are definitely pending orders around those zones, whether it is for a high or for a low. That is what we call a liquidity grab. Okay, it does that instead of it's not like the case, just like price was selling and then it decided to buy. Okay, then price decided to take out this particular level. It's not as if he took it out to continue buying. He took it out only to still reverse to that direction of which those people that have that order was hoping that price would go. You would have already taken them out before going on that direction. So what do you say in that situation? You just know that price was seeking liquidity. So we have something like a liquidity sweep. A liquidity sweep is when price moves through a liquidity area and clears multiple levels before making its next significant move. Compared to a liquidity grab, a sweep usually covers a broader area and moves more liquidity. I'm going to quickly go to my GBP/JPY chart to show you an example of this thing, because it just happened recently on GBP/JPY. So let's just quickly rush there and then we'll come back. We'll come back to this level. All right. I think it's around here. That should be it. Exactly. So this was what price did. you notice that there are actually several liquidity levels. Price has been buying, and it has created all of this, all of these levels, okay? And in most cases, it doesn't even come back immediately. Price decided to come back. Look at it. This is what a liquidity sweep. What did it do? It cleared this level. First of all, a lot of us were hoping to buy from this level as usual to continue the uptrend, but price failed it. It came here. We were having hope that okay, it will stop here. Price did what? Price cleared it. Here too, price cleared it. And then price came reacting from this level that you don't even understand what POI is there, because there's no valid POI here. But of course, price has already had a sweep, because all it wants is what? Liquidity. And it has been able to gather the liquidity that it needs. So we are expecting more movement from price, either to continue the upside or still to continue the downtrend or to continue the sales. All right. So that is just what liquidity sweep is all about. Quickly back to where we were coming from. All right. I actually want to show us a chart example of everything that we have talked about. I'm still going to use a particular area of the chart to explain it, but before then, let's talk about the importance of what? The importance of liquidity. First of all, liquidity actually helps you to understand where price is likely to move. Okay, it gives you an understanding of where price is headed next. It helps you to avoid common stop loss hunts, because if you know liquidity, you will not be stopped out unnecessarily on your trades. It helps you to identify high probability trading opportunities. All right. This is when you have already identified your trend, understood your structure, and then you put in your knowledge of liquidity. It helps you to understand high probability trading opportunities. It helps you to trade in line with the institutional activity, because large institutions often move price towards liquidity before continuing in the intended direction. It's just as simple as that. Okay, so let me see if I will use the previous POI on gold, because this is SAUSD. Let me see if I can use it and explain something. Okay, for the first type of liquidity we talked about the inducement liquidity, transactional liquidity, and structural liquidity. Guys, let's just take a short break and then we'll be back. All right, welcome back, guys. So I want us to quickly run off a chart example on these types of liquidities that we talked about, because after all of those markups, if you don't see what it looks like on the chart, then you will still likely be confused even when you see them. All right, so let's start with this transactional liquidity, because that's the first thing I can identify here right now. This is my current gold setup anyway, and in the previous video on chart breakdown, I already talked about how long it took to for price to get here. All right, so in the transactional liquidity, we explained something like when price is on a particular trend and then it gives a change of character to which is indicating a trend reversal. What price does that, if that trend reversal is definitely going to hold, price cancels out the previous structure that it has created. So you can see that example for yourself here. Price was on a downtrend, creating lower highs and lower lows, until price created this particular lower high, and then instead of taking out the lower low, it went ahead and took out the lower high, giving us a change of character on the 4-hour time frame. Okay, it gave us this change of character, and what is the next thing? Price came, validated the POI that the change of character left behind. Okay, and then price continued the buys. Now when price has continued these buys, it has also broken another structure to give us another swing, to give us a more confirmation that we should look out for several buy entries. All right, now the rule of transactional liquidity states that like we said, actually states that once there is a valid change of character on a particular trade, price tends to use the previous externals as transactional liquidity. So since there is this change of character, the next thing price is going to do, as you can see, it has already started buying. It is going to start using other structures, other external structures, that is these sell structures that you saw. Price is going to use them as liquidity. So it's going to keep cancelling them out. So you can actually decide to use these levels as your take profit level for those that are buying. Okay, because there are liquidity resting above these highs that you can see. So price will keep picking them out. Take out this one, this one, take out this one, okay, and that is how it will do it until it finish taking everything out, okay. And the same thing, like I said, as trend line liquidity. So this, let's assume this is a downtrend. Of course, we draw our trend line. So price is going to what? Price is going to cancel out every liquidity that is found on this bearish trend line. Price is going to what? Price is going to take them out. Okay, price is going to take all of them out. This is where we have had our change of character. In fact, it's even now that we're actually having that proper change of character. I think it was around this region that we had that proper change of character. All right. So price is going to what? That's for trend line. But for SMT, this is where the change of character happened. All right. But for trend line, this is where the change of character happened because price broke trend line at this point. So the next thing price is going to do is to what? To take out all the liquidity that it has created, or all the structures that it has created while it was selling down, and that is what that's what a transactional liquidity is all about. So the next is inducement liquidity. Let me take this out. The next is what? Inducement liquidity. Unfortunately, on the higher time frame, price in fact, generally gold uses engineered liquidity. So that's another type of liquidity that we are going to talk about as a topic on its own. Engineered liquidity. Like I said, we are still going to have a chance to explain other types of liquidity as a broad topic, just to help you understand. This is just a rundown. So we are going to go over to the 1 hour time frame to see if we can have a proper understanding of the structural liquidity and the inducement liquidity. Okay, so we have this here. This is where the setup actually happened. This is where the first change of character happened. Okay, so first of all, we said the inducement liquidity, the last break of structure is the inducement liquidity. So we have a break of structure here. You're seeing my cursor to show that there was a break there. Price pulled back into this level and gave us a new break of structure, which is now seen as the inducement in this context. This is a lower time frame, not a higher time frame. All right. So when price gave us this, remember, like I said, a valid break of structure must have what? Its structural liquidity inside, which brings us to the structural liquidity that we are also going to talk about. You can see that there are also minor breaks inside this break of structure from this level to this level. In fact, let me mark it for you to see it. From this level, this is the first break of structure. This is the second. This is how the break of structure happened. This is the second break of structure. All right. Now inside of it, you can see that there are several breaks. You can see that there are several minor breaks inside of it. Remember, this is even an internal on its own. But if you're looking at this level, you'll get to see that there are several breaks. For the second break of structure, you can see that there are even two breaks of structures that made it up. Okay. So now I've been able to identify both the inducement and the disruption in this particular structure here. Okay. And now price decided to, this is gold, so it will not give us the exact figure that we need, because like I said, it uses what? Engineered liquidity. So if anybody had bought within this area, price will likely behave as if it is ready to buy, because that's what an inducement is for. It is there to lure early buyers. It's there as a trap. It will come react from that level as if it wants to actually buy, and then you see it will come back and react to the main level. Okay, because there is no actual inducement that is very close to this is our P, because our POI is supposed to have its own little inducement as well. Because there is none, price created this. That's an engineered liquidity very close to this level before tapping in properly into this other block and then bought massively to the target. All right. So I think I've been able to explain what structural liquidity is all about. As you can see, every break of structure here has all of the structures inside. That is the minor breaks inside, which is known as what? It's structural liquidity. So back to what we're talking about. Okay, sorry. Let's talk about the other type. Of course, we already talked about the buy side liquidity, which is the one we find around this range. So you see that this is the range that we're supposed to take profit for buyers. But some sellers that are expecting price to sell will likely place their order around here. And what did price do? Price came and swept them off, swept off their buy stop orders, okay, and cleared all their stop losses. All right. So for the internals, we also have, we talked about the internal range liquidity. That is the one that you see here. Price actually swept it, which is also the inducement one that we talked about on the other time frame. Price swept it and then went ahead and still swept this external range liquidity. Notice that it swept the internal range liquidity first, which is this liquidity you're seeing here. It swept it before going to the external range to clear it off. And then we talked about liquidity, liquidity grab, of course, which is also around this level. Price has cleared the liquidity within these swing highs. Okay, then for the liquidity grab, I've already shown you an example. It clears several liquidity. As you can see, there are also several liquidities here that price cleared. Okay, there's several liquidity that price swept around here, but we can call this more of liquidity grab and liquidity sweep. The liquidity sweep, you will see price, it sweeps them and then heavily rejects, just like what I showed you on the GBJPY daily time frame. You see that price swept it and there was what? A rejection candle. That's aggressive rejection. That's what a sweep looks like. Okay, price has to just reject to show you that indeed there was a sweep. And then that sweep swept out several structures, several points of liquidities and not just one. Okay, so I think that's like everything I need to talk about in liquidity. So the key takeaway for this is that liquidity is where large number of buy or sell orders are concentrated. Buy side liquidity is found above previous heights. Sell side liquidity is found above previous lows. Okay. External liquidities. Oh my god, I need to. External liquidities. The external liquidities are located at major swing points. Internal liquidities are found within current market range or market structure, within current market structure. Then price often seeks liquidity before making its next significant move. Don't assume every break of a high or low is a breakout. It could be a liquidity grab or a sweep. Okay, so you need to pay attention to these things. You need to also know that the market does not just move randomly. It often moves towards areas where others are concentrated. If you can identify where liquidity is resting, you will have a better understanding of why price behaves the way it does. I'll take that again. If you can identify where liquidity is resting, you will have a better understanding of why price behaves the way it does. All right, so that is the end for this particular video. Okay, and in the next video, I think we'll be explaining, other types of liquidity. We're going to be explaining it in more details, or I think I've already done every explanation here. But yeah, maybe in other videos, but by then I will have to make sure that I cover other parts of, advanced trading strategies, okay, before I come back to it, because I've already given a rundown of all the types of liquidities. And as you can see, the first one, like I said, this is a rundown now, is the inducement liquidity, the structural liquidity, transactional liquidity, buy side liquidity, sell side liquidity, internal liquidity, that's internal range liquidity, external range liquidity, and then I think we were able to cover only 7 here. Okay, we covered about 9 of them, because after internal range liquidity we have the liquidity sweep and the liquidity grab. So we also have engineered liquidity. I think that's the next one I'll be talking about on a more broader sense of it. Engineered liquidity. We also have draw on liquidity. So I'll be talking about those two liquidities. And trendline liquidity, of course, I've used transactional liquidity to explain trendline liquidity. Okay, so I think after these other two types of liquidity, the draw on liquidity and the engineered liquidity, that would be like the last part of liquidity I would likely talk about. Okay, maybe there are other types. Of course, there should be other types, and I will still talk about those ones later on, not now. Okay, maybe over time we'll talk about, because like I said, there are myriads of liquidity, but they are all connected to the same thing. It's good to understand all of them. Okay, so the next video is going to be on range. Okay, and maybe after range we can talk about the engineered liquidity. So guys, that's the end of this video. I hope you understood and I hope you enjoyed every part of this video. If you did, please click the subscribe button and subscribe to my channel, because that's the easiest way you can support me. You're not giving me money, you need to support me by subscribing to my channel. And of course, I want you to like and comment on this video, share with your friends so that they will learn with you. Even if you know them, let this serve for like a refreshing course for you. All right, so guys, with that being said, see you on the next one. Bye.